Okay, so question 4, let's quickly see what they ask you before we go through all the information. Okay, so question 4, they ask you to journalize the adjustments for point number 2, 3, 7, and 8. Narrations are not required. Okay, so in this instance, you have to do the journals, similar to question 1, but in this scenario, you do not have to give the narrations, so you do not get any marks for that. Then the next thing they want you to do is prepare the statement of profit and loss and other comprehensive income, and then the statement of changes in equity. Now, if they ask you to journalize something specifically, it would generally be the adjustment which would affect your statement of profit and loss in the scenario and potentially your statement in equity. Okay, so it is very important that you know how to do the journals because that would impact your disclosure. And for the disclosure, how you start it is if they ask you statement for profit and loss, you do the little framework and the statement of changes in equity, you write down the framework, and as you go through the information, you plug in the figures so that you can still get marks as you go along. Okay, so that is how you should attempt a question like this. But let's go through the information to see what have they given to you. So they tell you Young Traders is owned by Yvonne Young. It's not a VAT vendor and uses the perpetual inventory system. Okay, so it's not a VAT vendor, so that means you do not have to remove VAT and the amount would be inclusive of VAT in the scenario. If we use the perpetual inventory system, we apply our inventory as assets. So this is where we apply our first semester information. Goods are sold at a markup of 50% on cost. Okay, so in the event you have to use it, your cost price would have been 100, your profit would be 50, and your sales price would be equivalent 150. Okay. Then they tell you the pre-adjustment trial balance for the year end is 30 April. So this is our pre-adjustment trial balance. Our year end is 30 April. Now what is important to note here is if they state something as 1 May, that means it has not been adjusted as yet. Okay, so that means there will be some form of adjustment potentially for this information. Now, capital at 1 May, that would go to your statement of changes in equity. I'm just going to make here a statement of changes in equity. Okay, so accumulated depreciation, because it's the 1st of May, we would still have to account for depreciation. In that scenario, allowance for credit losses, we would have to do the adjustment for this potentially based on the information. And then let's look at the other information. So here is sales and cost of sales, and this is where your statement of profit and loss information would come from. Okay, so from the sales scenario downwards. Okay, so let's quickly share the Excel, then I'll just show you how do you start this question in the exam. Okay, so so the first thing is the journals. Now the journals will be based on the additional information. Now before we even start with the journals, because we know we need to do the statement of profit and loss, I want you to go do the little framework like this. So it will always look the same. So you start with revenue, your cost of sales, gross profit, add other income, and then you leave a gap for any other income, less to work out your gross income, then less your distribution, administrative, and selling expenses, leave a bigger gap for that one, and then profit or loss before finance cost, less your interest expense, and then it is your total comprehensive profit or loss. Now, before you start this question, you won't know if it's a loss or profit. So what you could do is you can do profit / loss. So that if you run out of time and you do not get to correct it, you have indicated to me what is a profit, you have indicated to me what is a loss. So I still can give you the marks for it because you have actually shown what your figures are. Okay, so this is just a little trick if you might potentially run out of time, how you document it for us so that we can still give you the marks. Okay, so this is the framework for your statement of profit and loss. So you just go draft the basic framework, and then as we go through the information, we complete it. And then your statement of changes in equity, you've got your balance as at 1 May, you've got your additional contributions, you've got your loss or total comprehensive loss for the year, drawings, and then your balance. Okay, now based on the information they have given to us, you could already start completing some of this information. Okay, so on the pre-adjustment trial balance, they have given you a sales value of 1.467 million, and then remember you deduct the sales return amount of 70,000. So you can already go enter that information into the brackets before you even start with the additional information. Your cost of sales, they've given us a value of 914,000, so you just go enter that in there. And then we've got our, okay, let's see if there's other income. So there's sales return, salary, stationery. Okay, so currently there's no income. We've got our expenses, which is our salaries and wages, which is your 640,000. So you just enter that so long. And we've got our stationery, which you can enter as well. So you literally what you go do is you go write down the expenses, you open the account with the balances that they've provided to you. Okay, so why do we do it this way? You generally get half a mark for each amount you reflect, and then for the adjustments you generally get additional mark as well. So this way you have already done 1, 2, 3, 4, 5, 6, 7, 8. So you've already scored 4 marks just by entering what they've given to you. Okay, not even doing any adjustments. And then if we look at the statement of changes in equity, we know that the opening balance, they've only given us the capital balance in the beginning of the year. So you go into the capital balance of 1.2 million as your opening balance. Okay, so there we've already got 4 to 5 marks by just applying the information that was provided. Okay, so I'm going to share the PDF again so we can go through the additional information. Okay, so let's now go look at the additional information and how we need to deal with this. Okay, now how I would suggest you do this is as each and every transaction is done, I would go and account for it as we go along to make sure that you have actually documented it. So where I will account for it is I'm just going to show you the adjustments for now on the pre-adjustment trial balance, but you would physically go do it on your answer book as you go. Okay, and then we'll do the Excel. So the first thing they tell you, according to the physical stock tax, stationery on hand amounted to 4,500 and trading inventory amounted to 147,000. Now, if we go back to our pre-adjustment trial balance, we would see inventory is 149,000. So to get it to 147,000, we will have to deduct 2,000 here. Now, if we decrease our inventory, we would also have to increase our cost of sales with the same amount. Okay, so that is the opposite sign of the increase. Then we also, based on the information, they've told you that stationery on hand is 4,500. So that means we also need to include an amount here. So it's normally consumable stores on hand. Now remember, you don't have to do the balance sheet portion of it, but I'm just doing it to show you the full amount. So that would have been 4,500 that you include here on the debit side. But if I include it under consumable stores on hand, it means I need to deduct it here from the stationery amount by reducing it by 4,500 Rand. Okay, so that is what that means. Then entry number 2, an amount of 2,500 was prepaid on carriage on sale on goods that will be delivered in March. Okay, so this is a prepaid expense. So what we have to do for prepaid expenses, you have to reduce the carriage on sales with the 2,500, and then we would add, I'm just going to do for the adjustments here at the top, we would have a prepaid expense of 2,500, okay, which would be a credit. Prepaid expense. No, debit. Okay, so we would create the prepaid expense, we would reduce the carriage on sales. Then the next entry, a debtor went insolvent and his debt of 3,500 must be written off as irrecoverable. Now remember, you have to go look at what is the account name. So in this scenario, they've given you credit losses. So we would add the 3,500 to the credit losses account here. And then our debtors control at the top, we would then reduce with the 3,500 as well. Okay, now for your scenario, you basically only have to deal with this bottom part to do your statement of changes in equity, statement of profit and loss. You do not have to deal with the assets and liability sides. This is just to show you both sides so that you understand how the entry works. Okay, they tell you that, does someone have a question? Okay, then point 4, they tell you the allowance for credit losses must be adjusted to 2,000 Rand. So what they tell you is your balance needs to be 2,000 Rand. Now let's go look at what the balance currently is. So currently in your trial balance, our balance for credit losses is 2,500. So it needs to be reduced to 2,000. So we need to deduct 500 there. Now, if we reduce a credit, we would debit it, which means our allowance for credit losses adjustment allowance. Okay, so because we debited the negative asset account, we would have to credit this account with, credit with the 500 Rand to get to the allowance for credit losses. Okay. And because that is a credit, this would be shown as other income in my statement of profit and loss. Then we provide for depreciation of the vehicles of 55,000. So this is depreciation, which is an expense, and they've given you the value, which is 55, so we're just going to add it to our expenses of 55. Okay. Then the next one, they tell you the owner withdrew 215,000 for personal use, and it still needs to be recorded. Now, as soon as you withdraw something for your own use, this is drawings. Now, drawings get recorded in your statement of changes in equity. So what you would do is you would automatically go input this information in your statement of changes in equity when you do the information. Number 7, they tell you an amount of 1,000 Rand for telephone was incorrectly debited to salaries and wages. And we still need to correct the error. Okay, so what does that mean? Is our salaries and wages here at the top needs to be reduced by 1,000 Rand because we made an error. And our telephone, on the other hand, needs to be increased with 1,000 Rand to correct the error. Because I'm just going to add here the depreciation amount as well. Depreciation would be a debit balance of 55,000. And we would have added the 55,000 here at the top. Just so that you can see where it goes. Okay, then we've got the last item. Young traders invested the fixed deposit of ABA Bank on 1 May. So in the beginning of the year, the fixed deposit will mature 30 April. So that is only relevant for disclosure purposes when it matures. It will show you whether it's a long-term or short-term asset or current and non-current. Now, because it will mature 30 April 2021, it will mature within the next 12 months, so it would have been a current asset in the scenario. And then the interest for the current year must still be provided. So that means we still need to calculate the interest. Now, if we look, our year end is 30 April, so we've opened this in the beginning of the year. The balance for the fixed deposit was 75,000. Multiply with the 12% will give us the interest amount. So our interest income or interest on fixed deposit will still have to be included. Interest on fixed deposit, which is also other income, would be your 75,000 times your 12%, which would be 9,000 Rand. Okay, so that would still also have to be included. Okay, so I'm going to stop sharing this and then we're going to go complete the Excel with the information. Okay, so they wanted us to do the journal entries. So let's start with the journal entries for entry number 2, which was the prepaid expense. Now remember, when you have to remove something, we would credit the expense that was incorrect. So this was carriage on sales. We would have credited with the 2,500, and that means we would debit the prepaid expense with the 2,500. So if you're unsure which side the prepaid expense, accrued expenses, start with the income side first, and then the opposite side would be the other entry. Okay. And you do not have to give narration, so that's why I've left it blank. Then they asked you point number 3, which was your debtor that is insolvent. Now remember, if a debtor is insolvent, we would credit debtor's control, and you indicate the debtor's name, because if you need to do an individual adjustment, it's easier to pick it up for 3,500, and then that means we debit the credit losses, our expense account, with the 3,500. Then entry number 7, the journal you had to do for the correction of the error. So 1,000 Rand was taken to salaries and wages instead of the telephone account. So that means telephone needs to increase. So we debit it and we credit salaries and wages, and the amount that needs to be adjusted is the 1,000 Rand. And then number 8 is the interest we still need to account for. Now, because it's a fixed deposit, you would say debit accrued income, so it's income that we have not received as yet, but will still receive. We would credit the interest on fixed deposit. Interest income would also be correct, and then you do the calculation, which is 9,000 Rand. Okay, so you can see here what they've done is they've actually prompted you to do the journals in order to do the corrections on your statement of profit and loss. So what we do now is after we've done the journals, now we continue with the statement of profit and loss. Now we know that there was no further adjustments to revenue. So the revenue figure is just the amounts that were given to us. So the sales value less the sales return. For cost of sales, we had to add an additional 2,000 Rand to reflect the correct cost of sales value. Now, very important to note here, your cost of sales needs to be shown as a negative amount, okay? And you deduct that from your sales, net sales figure to get your gross profit of 481,500. Now, other income based on the information was our allowance for credit losses adjustment of 500 Rand, and then your interest on your fixed deposit, which was based on the journal you done at the top. And if you add all of those together, you get your other income of 9,500, which you add to your gross profit to get a gross income amount of 491,000. Then we move on to the expenses. So we know salaries and wages had 1,000 Rand included. That should not have been there. So you deduct the 1,000 Rand to get to a value of 639,000. Stationery, we had a portion that we took to consumable stores, the 4,500, which we removed. And then carriage on sales had a portion that was prepaid, which we deduct as well, which was based on your journal entries at the top, the 2,500. Your credit losses had to be increased with 3,500, which was also based on one of your journal entries. And then the telephone is increased with 1,000, which was also based on the journal entries. Okay, so you can see based on the information here, everything except the stationery one was already adjusted for based on what you've done here. So they've actually tried to help you by asking you the journal entries to complete your statement of profit and loss. Okay, so once we've updated those amounts, we're still missing one account, which is the depreciation amount of 55,000, which we then add to get to our total expenses of 895,700. Now, what is important here is that that is also a negative amount. If you run out of time and you cannot do the subtotal, make sure that all of these expense amounts here on the left-hand side is then shown as a negative so that you can still get the marks. Okay, that's just some tricks of how to do it. Then to work out the profit and loss before finance charges, you take the gross income less your expenses. Now in this scenario, we've got a loss. Now you can see if you weren't sure whether it's a profit and loss, if you indicated it's a loss is a negative, you would have already indicated there. There was no information on any additional interest expenses. So our total comprehensive loss for the year is the 404,700. Now this value here is what you transfer to your statement of changes in equity. Okay, make sure that you take whatever you've calculated, you get a method mark for this. Okay, so it needs to agree. Then the drawings information, based on the additional information they've given us, the drawings amount was 215,000, so we would capture that in here. Now remember, drawings reduces your capital balance, so you show it as a negative. There was no additional capital contributions during the year. And then if you add all of that together, your closing balance is 580,300. And that is how you're supposed to do the disclosure in terms of question 4. Okay. Okay, and that is what we had to do for question 4. Do you guys have any questions based on the disclosure and the adjusting entries for question 4? Okay, guys online, do you have any questions so far?